without further ado, would like to introduce our self-storage managing partners, John and Chris. And if you guys would, just tell us a little bit about yourselves and then what you focus on specifically in our storage business. John, we'll start with you.
Sure. I'm John Allen, and I oversee the underwriting, a lot of the acquisitions process for us. So if we have a deal, I'll have the coordination with the legal team and the other teams that are involved, as well as get involved with the asset management of our storage assets and a lot of the finance side as well.
Nice.
Yeah.
And Mr. Bennett?
Hey everybody, I'm Chris Bennett. I oversee our broker relations, finding deals, the acquisitions process, getting that going. I usually go out and travel and meet brokers, look at deals, tour deals, and kind of fill up our pipeline with deals that meet our criteria, and then hand it over to the acquisitions, the underwriting and financial aspect of things. So that's John, and we have one analyst as well, Vic Werner, who does all of our underwriting. So yeah.
Okay. Nice. Well, thank you guys for being here. We're just going to dive right into it. So a couple things kind of that have occurred recently that impacts our business and a lot of businesses, interest rates. So 25, 50, 75, 75, 75, another 75 basis point hike at the beginning of this month. Fed signaling potentially another one before the end of the year. So obviously interest rates have impacted our ability to acquire assets and our pipeline, et cetera there. So definitely want to talk about that. Inflation's down to about 7.75%, but still definitely an impact there.
Right.
And we're likely in a recession now. I mean, I think, depending on who you talk to and what metrics they use, but it seems that if we're not there, we'll be heading there. And so just that's kind of the backdrop for the conversation today. And so talking about storage as an asset class, why are we in it? We were doing very, very well with multifamily. You've got about $1 billion in assets just in the multifamily space. So why did we add storage as an asset class? What do you see as in terms of our group? What do we like about it? And then why historically have investors like storage?
Yeah, I guess going back to the first question of why we're in the business in the first place, I got started in the business back in 2017, was working for another company. We pivoted to acquire self-storage assets in a fund, and I headed up that whole process. So I was able to see just the fundamental workings of storage and how it operates, how it functions, how it compares to maybe some other asset classes, and I fell in love with it. But beyond that, I would have to do research, obviously, and look at data and try to figure out, hey, is this actually worth jumping into from a data perspective? And so just through research online, et cetera, pulling up data from some resources, you can look back at 08, 09, the big recession at that time, where how storage performed versus other asset classes and versus the market. It was one of only asset classes out there as far as real estate is concerned that actually had a positive return in 08, 09. And it performed well since then. So much so that the government got involved and said, hey, if you want a loan to own and operate a storage business, we will do that through the SBA. That's how much confidence the government had in the asset class moving forward after that Great Recession. Then you look even further, just the performance during the 2010s. And then going into not the last, but hopefully the last pandemic ever.
The most recent pandemic.
Exactly, yeah. The most recent pandemic in 2020, the performance of storage during that time, it just skyrocketed because of the change in people's lives, downsizing, working from home, et cetera, driving the demand for storage space. So if you look at it from not just us talking about it because we're involved in it, but look at just third-party data to say, hey, this has performed well in past recessions, and we believe it will continue to perform well going forward. So that's the one reason that we're in the asset class.
Love it. So I want to dig a little bit there because I think you hear that a lot, that it's recession resilient, recession resistant. What is it about the fundamentals of storage? What makes it different than kind of any other business in our economy, right? That does a lot of this. Depending on GDP growth and good economic environments, et cetera, because it seems like storage is just steady as it gets. So what is it about the fundamentals of that business, the tenant profile, that make it so steady when everything else is volatile?
Yeah, it's interesting, because I think some people who look at it from the outside in, they might think how I can't wrap my head around the concept that people actually need this extra space. Right, and I'm one of those people. I'm guilty of that. I don't store or keep things. I don't have a unit. I tend to get rid of stuff. But I found out that there's a lot of people out there that need the space because of, for one, obviously driven through the pandemic, where they had to downsize or make room for a home office or whatever the case may be. That actually created a fundamental shift in people's thinking that, hey, I need some space. Let's go ahead and rent a unit, a 10 by 10, a 5 by 10, whatever it might be, to make some space in my home. Beyond that, you hear this a lot in articles and whatnot, like there's the 4Ds of self-storage, and it's driven by change in people's lives, essentially. So somebody might go through a divorce, they might be moving, whatever. They need some space to store their stuff in the meantime. That story makes sense until you dig into it a little bit more and you realize, hey, it makes even more sense because once you move your stuff in, it's actually kind of difficult to move it out. You have to have the willpower to say, hey, I'm gonna go down there and get all my stuff loaded on a truck and move it to I don't know where, or sell it or whatever. So once you get in there, usually customers tend to stay longer than they expected. And they find out, hey, we might do a $10 rate increase, but it's not worth me calling my friends and unloading my stuff and moving it down the street to the facility that has the same amount of rent for the same unit. So the tenant base tends to be sticky in that regard. So when they say fundamentals of storage, that's what they're talking about. The customer, their needs in their life, combined with the fact that it takes a bit of willpower to go down and move out of the unit, physically move out. So they tend to stay a little bit longer. They're more sticky in that regard.
That makes sense.
I think too, you mentioned the 4Ds, as being the driver. So if somebody's going through a divorce, if there's a death in the family, or one of them's dislocation, which means moving. So if you think about all of those things, they are changes, but they are things that are always happening, right? So, with multifamily, we think everybody has to have somewhere to live, right? Well, these changes that drive storage, some of them more unfortunately than others, are always going to be there. So I think that's another thing.
Yeah, they dovetail very nicely together. Absolutely. Yeah.
And then how much has the downsizing and shuttering of retail office spaces as well increased the demand for storage with small businesses that need a place to store their stuff?
Yeah, you can see that play through in occupancy. So the best data for occupancy and all that is going to be REIT data because it's public. Anybody can access it. Occupancy is maintained right now in the mid-90s or so across the board, which it kind of always hovers around that for the REITs, maybe low to mid-90s, somewhere around there historically, but their rents are up higher. And so that's showing that, hey, occupancy stayed the same. People have, some people move in and move out. You have that seasonality to storage, but they're willing to accept higher rents, higher rates. In some cases, 20, 30% higher than they were pre-pandemic is what we call it. So they're staying longer again, and they're accepting those rate increases because they need the space because of the change in their life driven by the 4Ds that we talked about and by the fact that they need to declutter, which is the fifth D, making space in the home to work from home, et cetera. So those are some of the reasons why, obviously, but yeah.
It's also contributed to even the seasonality has been not as much of a factor as it historically has been. Typically you have your peak season would be the spring and summer, and it'd be a little bit lighter in the other months. But even that has been not quite so big of a factor.
Yep.
Makes sense.
Yeah.
So let's talk about our portfolio. So we actually started, I think, right around the same time. And y'all were brought on because of your expertise in the space to really head up our storage business and that asset class focus for us as a group. So starting from zero, tell me about our what we've acquired, what we have under management, and just kind of a high level overview of our portfolio.
Yeah, so I'll start it off and then if you want to chime in. So we started acquiring assets in, I think it was around, our first one was like February of 2021. The years kind of blur together. So we haven't quite gotten to 2 years just yet, but within about the first year and a half, I would say, we acquired about $120 million worth of total in assets, almost 1 million square feet of self-storage. So we're literally starting from ground zero, I guess you'd say, to building up to a nice size portfolio. And those are all average of, call it maybe 60, 70,000 square foot facilities. So not smaller facilities, larger institutional quality type facilities. So it's taken a lot of hard work, obviously, good partnerships, good communication, just a lot of no's until you get to a yes. But building that portfolio over the last year and a half, 2 years or so has been a challenge, but very rewarding. So, and obviously we want to thank our investors who do trust us and with their capital to go out and do that. Without them, we wouldn't be able to do that. So we do really greatly appreciate it.
Thanks.
Yeah.
And tell me, you mentioned you're looking at a lot of deals before we put one under contract. What's our back of the napkin ratio. How many deals are we looking at before we actually get to a
Yeah,
contract?
we'll look at about 100 or so. So we have about a 1% close rate.
Okay.
We'll look at about 100 or so, and that means like everything that hits our inbox.
Right.
So we'll look through the emails and say, okay, it doesn't fit the market or doesn't fit the size or whatever the case may be. Then we whittle it down to the ones that do fit the criteria, and then from there underwriting and making an offer. But it's about call it 1% or so close ratio.
Okay.
Yeah.
Definitely a numbers game.
For sure.
Yes.
Obviously.
Yeah.
And so to date, 12 assets. Do I have that right?
I think so.
Yeah.
That's right.
John, I'll ask John.
Yeah,
John knows.
If you want the numbers. Yeah.
Over 100 million in value across 3 states, I believe. And what do we like about, we're in North Carolina, South Carolina, and Colorado. So what is it about those markets? Because one of the questions that we got, and I'll hit this one now, is I see storage everywhere, right?
Yeah.
I see storage being developed everywhere. I feel like I'm seeing storage. And part of that's the, I forget what the scientific term is, but the
Yes, you
reticular
buy a car.
activating system, right? You buy a car, you see it.
Yeah.
So once you start getting invested in storage, you see storage everywhere. But there is, you do see new storage development. And so, the question is the markets that we've chosen, why have we landed on those? And is there a concern about, overbuilding, oversupply in those markets? Can you speak to that a little bit? Either one of you guys.
Yeah, I can start that.
Yeah.
So as far as the markets that we're in, so it's primarily, as you said, there's 3 states. We're primarily in the Triangle area of North Carolina, the Charlotte area, as well as the Greenville area in the Carolinas, and then Denver, Colorado would be our other sort of primary market. All of those markets there's a lot of population growth there, which is the biggest thing that we like about them. It's also, one of the things that emerged during the pandemic was people kind of realized the more they were working from home, they had a lot of flexibility to live wherever they wanted. So we're not just the markets that we're buying in are not just markets where there's a lot of job growth. It's also where people like to live. So no matter where they're working, we've got places that people like to move to.
Yeah.
Absolutely. You think of Denver, Colorado. There's so much to do out there, outdoors speaking. So it's a great place to live and work and play, obviously. So we want to be in a market like that where population is growing. People need storage. There's dislocation, the moving aspect of things. So we like that a lot. We mentioned the overdevelopment. I laughed because several years ago, 2017 or 2018 or whatever, I took an Uber and the guy, we were just talking and he said, I told him what I did. I looked for self-storage. He was like an older gentleman, 50s or 60s or whatever. He said, do we really need more storage? So it was like some random guy driving a truck. He even knew that, at that time there was too much storage going on.
Yeah.
And if we went back to that, I actually agreed with him and said, yeah, in most places we got too much. So at that time we were overbuilding in places like Denver, Colorado, and other places in Texas and whatnot.
Yeah.
And there was some worry, some concern over that. So every market is specific, it's localized, right? So you might have some overgrowth or overbuilding in one part of Houston, for example, Texas. But in another part, you might not have as much supply. And so to generalize, we might be oversupplied in some markets in 2017 leading up to the pandemic. But post-pandemic, we found out, all of that actually was absorbed by consumers. And right now, there isn't a concern of overbuilding. Construction has slowed down because of higher inflation and rising costs. So that's good, it's keeping developers somewhat in check. So right now, yes, pre-pandemic, there was a little bit of concern with that, with overbuilding in certain markets.
Sure.
Post-pandemic, not so much, although it is something that we definitely keep our eye on. When we look at a deal, for example, we'll look and see, is there any development coming in the area? And if there is, it might be something we pass on. Yeah.
It's also to the supply side, the overbuilding. That's only one half of the equation. We always look at not just, what's the supply in this market? We look at what the demand is. And so we're doing a lot of due diligence, calling, the competing facilities, seeing are they full. So it's really, you have to look at both sides of the equation.
Yeah, absolutely.
That makes sense. Okay, so current portfolio, what would you say in the almost 2 years now that we've been operating with the assets that we've acquired? What would you say are the high points of performance, acquisitions? Like what comes to mind when you think, man, we really acquired a great asset there, or we've really been able to execute something solid in the portfolio?
Yeah, I can give you a couple of them. So we have 2 lease-up properties that we acquired in particular over the past 12 months. One of them is in the Mebane, North Carolina area, so just outside the Triangle. And that property we purchased, it was about 20% full. It had only been open for a couple of months. And typically with storage, you'll see about a 24-month lease up. And we have gotten that to about 75% full in 12 months. So, and we were not able, or we did not need to discount rates so much as a lot of operators have to do. So I think that particularly speaks to that market. It's also, one of those Class A, multi-story, very nice looking assets. So that has been a big success, I think, that particular property. We also acquired a lease-up property out in the Denver area, North Denver, in Brighton, Colorado. And that property was one that the seller it was actually, they had had it open for almost 2 years at the time that we acquired it. But it was not very well managed. It was managed out of state, and just there were a lot of inefficiencies there. And they had only gotten it 30% full in those first 2 years. Well, we've taken it since this past January, and it's now almost 70% full. So we were able to solve some problems there that the previous owner had not. And I think those have been two solid assets for us.
Nice. Now, I'm personally curious. When you say, what were some of the shifts or the pivots that we had to make at that asset to go from a really very slow, glacially slow lease-up trajectory to a very impressive and rapid one? What do you see there are the mistakes that either inexperienced or disengaged operators make, and what's the value that we're able to come in and provide where you see that dramatic shift in the occupancy?
Yeah, so I think that there were two things in particular. One of them was it was just being not remotely managed, but it wasn't getting the attention that it needed to get. So the management company, when we looked them up, they had very few properties under management, so they seemed to be somewhat inexperienced. We also noticed that the seller had not been doing very much marketing, and very significantly not the right kind of marketing. And so we were able to implement some marketing strategies there, and keep a better pulse on the asset itself, and we were able to overcome some of those leasing deficiencies that they had. And those were things that we identified during due diligence. We weren't rolling the dice on the asset, so to speak. They were problems that we saw that we could solve, and we've done so.
Yeah.
I think that's one of the beautiful things about storage is when you see an underperforming asset, you don't really have to scratch your head a whole lot. I mean, it's like the history, right? You have decades and decades and decades of data to look at storage performance. That it's a great asset. That it's non-correlated with the economy because of all the reasons we mentioned with the 5Ds. And so when we identify an asset that we see as underperforming because of our operational strength, because of the marketing team that we have, all the different things, we can pretty quickly just look at the levers that need to be pulled, whether it's management, marketing. Oftentimes it's a combination of both, and make those pivots. So that's great.
That's right. Yeah.
So two bright spots there. What's been the biggest challenge? What's been the biggest learning, biggest kind of growth area for us or for you guys in this business?
I think in some ways back to the management aspect of things. So we had to make a switch in management companies kind of, I guess halfway through or so, or early this year. And we realized that, there's nothing wrong with either business plan when you run something remote 100% or you run it 100% staffed. It's a matter of actually servicing the customers in a way where they feel like they can actually reach somebody and somebody cares about them. So we had to make a switch, but we realized that, okay, you can do it either way and be successful. One way you can do it, you save a little bit on you increase your NOI, right? You don't have somebody on site full time. But you have to supplement that, obviously, with call center and some other things. But really comes down to communication with tenants, letting them know we're making a switch and this is what's going to happen, setting expectations with folks so that they don't become disappointed because they were friends with Susie in the office for so many years, and now Susie's no longer there. She's now answering the phone remotely, or whatever the case may be. So setting expectations with customers on the front end when we acquire a facility is going to help us on the back end after closing and maintaining occupancy and keeping the asset going in the right direction.
Nice.
Yeah.
Yeah, a lot of it's market specific too, right? So we've acquired some assets that were already run remotely,
Yep.
and so we've been able to plug our procedures in right away. There's others that I think one lesson we've learned is there's some where it might be a fully staffed facility that we can eventually run remotely, but we need to have a manager in place
Yeah.
on site there to kind of, like you said, walk tenants through the change
Ease that
and everything.
process.
Exactly.
Ease
yeah.
that process. Yeah. 100%. 100%.
That makes sense.
I mean, that's just scratching the surface. There's a lot more that we've learned
Yeah.
through the process.
Yeah.
But yes, that's one thing that comes to mind.
Okay,
Yeah.
very good. And then, I touched on obviously where we are economically right now. And so how has the change in the debt markets, inflation, et cetera, even supply chain issues, right, with renovations and value add projects we're doing at these assets, how has that impacted our outlook? And what do you guys see over the next, say, 12 to 18 months for storage, for our acquisitions pipeline, opportunities, challenges? I'll kind of leave it open-ended there, but just what do you foresee for the next 12 to 18 months?
Yeah, you want to speak to the debt markets?
Sure.
Yeah.
So I think with the debt markets, there's kind of two answers to that question. One is, how are we prepared for that?
Yeah.
And two is, what does it look like going forward, like you said? So, we have done, I think, a good job of having a good mix of debt. And what I mean by that is we have several assets that have loans that are fixed at a low rate. Which, of course, in hindsight was definitely the right decision.
Yeah.
Sometimes it's better to float than fix, but this was definitely good for us. So I feel like we are very well positioned to weather whatever sort of storm that we may be heading into from a debt market perspective. I feel like we're in good shape there. As far as going forward, it's, of course, as the cost of capital increases, that affects pricing. Mm-hmm. And the expectations that sellers have, they always lag the market, right? Because everybody wants to get, of course, top dollar for their asset, and it takes them longer to accept. Okay, I'm not going to be able to get as much as I could have got if I had sold 9 months ago, right? So it makes it, again, it's a numbers game, like we said before. It just makes it a continual numbers game. It's just about looking at as many assets as we can to continue to acquire.
Yeah, absolutely. I think what John said about the price discrepancy between what sellers want and where pricing is coming in based upon interest rates will make it a little bit of a challenge. I think some of the sellers who were not market sellers, they were just trying to get top dollar, those have probably been weeded out for the most part, earlier this year. But there will still be some of that lag going forward. So you'll still have some sellers with really high expectations, and the market is not going to be able to meet those expectations. So you do see a lot of, I guess, as far as inflation is concerned, to answer that part of the question, that will likely continue into next year. Nobody has a crystal ball, so we'll see. But as of right now, good chance that continues on into next year. We'll see what the Fed does. Good chance they're going to continue to raise interest rates, try and tamp that down. Possibly a chance that we may go into a deep recession. It depends on who you listen to and whatnot. So that's just on the surface. And yes, that does affect us. We look at deals on a longer term basis than just the next 1 or 2 years. So it's a 5-year hold in our underwriting. So yes, these are problems that we have to deal with as far as the acquisitions of new facilities and our outlook and whatnot. But we're looking not just in the next 1 or 2 years, we're looking 5 years out. So we're obviously we're responsible in our underwriting to make sure that we account for those changes in cap rates and whatnot. But the long-term, or I guess medium-term to long-term outlook on the asset class has not changed, despite the temporary ups and downs of the economy and interest rates, et cetera. So on the capital market side of the business, you still have a lot of dry powder out there looking to acquire real estate in general, hard assets in general, and then looking specific at each one. In storage and multifamily, of course, is top of mind for most investors and lenders, et cetera, because of the historical performance and in a sense, the trustworthiness of the asset classes. So there are temporary issues that we have to deal with over the next 12, 24 months, whatever the case may be. All things being equal, right? Maybe World War III or IV doesn't break out, hopefully, right? But all things being equal, we're looking further than that. We think our exit strategy is, it's dialed in, so we are not worried about that. Meaning, we go back to the markets question earlier on. Where have we purchased assets? We've purchased assets in good markets where we know we can exit to, whether it be one of the REITs or one of the top 10 institutional owners outside of that.
Right.
Just so that our investors might know at home, we've gotten calls from folks who work at those REITs and they want to acquire our assets at this point in time. We aren't ready to sell just yet, but they have put us on put themselves on our radar to make sure that we give them a call when we are ready to sell.
Yeah.
So that strategy is already panned out. So we bought desirable assets in good markets. We'll continue to do that. The transitory kind of temporary issues in the economy, yes, they're there. We're very aware of them and how they're affecting pricing and debt, et cetera, and management and all that. But we look beyond that to say, okay, are we in the right asset class? Yes. Are we in the right markets? Yes. Do we have a good exit strategy in place? Yes. So we feel confident going forward in the next 3, 4, 5 years that will be okay.
Yeah, yeah, and I think that's so important too, because we were joking before we started, right, about you just not watching a whole lot of the news, because if you do, then everything's ending tomorrow,
bad.
right?
Yeah.
And so, but I really do think that a function of so much of the economic and just kind of world news is it does cause us as humans to compress our focus down to with the next 6 months, next 12 months or whatever. So I think it's really important that one of the many reasons that we like this asset class and just our perspective as a group in general is that we're not really worried about this time. And to your point, we're positioned well. We've stress tested these. We've got reserves. These are assets that perform very, very well. So we're not looking at the next 12 to 18 months. I mean, of course, we're looking at it, but we're thinking longer term than that.
Yeah.
That's right.
And just knowing that when you're focused on the short term, everything does feel a lot more volatile. But when you're able to stretch that out and look,
That's
hey,
right.
we're on a 5-year outlook here, and we're positioned. If we need to hold it longer, if we get an offer ahead of time that makes great returns for our investors, we'll sell at the time that's going to maximize the value and it's best for the overall strategy. So I think that's really those are really great points. So I'm going to dig into some of the questions that were submitted ahead of time. One of the questions was around exit cap rates. When we look at the exit to institutions, talk a little bit about kind of what nobody knows where cap rate's going to go because they're largely impacted by demand and interest rates. But you mentioned an institutional exit. Talk a little bit about maybe some of the advantages of that from a sale price perspective to exiting to a big institution that may want to acquire more than just one asset.
Yeah. We can both chime in on that, but just from my own perspective, you look at let's just use Public Storage as a proxy for the institutional investor. They're the largest REIT out there. They own the most storage. They're under contract right now, according to their last investor report. They're under contract right now in about a little over $200 million in storage as of this recording. So they haven't obviously backed down on their purchasing of self-storage facilities. They become more selective, but they're not paring back in any way as far as not putting capital out there to work. As far as institutional is concerned, yes, cap rates will, they'll probably expand over a little bit. If interest rates continue to go up, we can expect to see cap rates go up, but they haven't expanded as much as you would think. Usually you have the 10-year and there's a little bit of a delta between the 10-year and where cap rates are, maybe 1% to 2%, something like that. So you would expect, cap rates should be shooting up now. We should be able to find lots of deals with, undervalued or whatever.
Yeah.
That's not the case because of the amount of demand from institutional investors like Public Storage, Extra Space, and the others that are out there, the top 10 buyers of self-storage facilities besides the REITs. So they're keeping cap rates lower. Right now, roughly, with our underwriting and what we're looking at in pricing and all that, stuff is trading around maybe a high 4 to mid 5, somewhere in there, which is obviously rates are above a 7 now, or right about a 7% right now. So it's a little bit, in a sense, upside down if you look at it in the short term.
Sure.
But it's because of the amount of powder, dry powder out there, the amount of capital looking to be placed in places where they think it makes sense, like self-storage. So we do underwrite cap rate expansion. We do look at that, of course. How could you not? But in the near term and obviously in the long term, there's still a lot of capital out there looking for good deals that make sense. And when they do make sense, they will be snapped up by larger players out there. So,
And do you think there's a potential for like a portfolio exit, right, where we take a lot of our assets and group them together and sell them to?
Yeah, that's always been the plan all along.
Yeah.
If we want to do a one-off, that's fine. Maybe some group wants to buy the 2 in Mebane or whatever the case may be. Like that's fine. We think of portfolio, we think of the whole thing, or maybe the entire state, all the ones in one city or whatever. But yeah, I think that does bring a premium, and I think that investors will, the institutional investors will gobble that up as long as the deals are, within proximity and they're in good markets like we have. So yeah.
I think the way that we are sort of clustered in a few different markets, it sets us up not just for a portfolio-wide sale, but to your point, we could have a Carolinas portfolio and a Denver portfolio, and they'd be good enough size where we could get a good premium for them.
Yeah, definitely.
That's great. RV and boat storage.
Ooh, we like you.
Yeah, well, so I've had a number of conversations about this asset class with investors. I know my team has as well. So, talk to me. You said you like it. So tell me why you like it, and then I'll play devil's advocate here. Going into a recession, does RV and boat storage suffer because it's more geared towards recreational kind of non-essential possessions? So why do we like it? And then is that assumption accurate?
Yes, yeah. So I think going forward, when you go into a recession, people tighten up the purse strings, right? And so you would probably see RV boat sales decline a bit, travel, some other leisure activities, hotels, et cetera. Those things would decline a little bit. So no argument there whatsoever. During the pandemic, RV and boat sales hit a new record. I forgot what it was. It was like $600 billion or something like that, $1 million worth of RV and boat sales. It was a new record at that time. So in other words, right now, there are more RVs and boats that exist out there in the US than there ever was that purchased during 2020. It was insane. So people need a place to park that kind of stuff. You can't park it in your driveway, at home because the HOA, et cetera. So they need a place to park it. They have to factor that into the cost of owning the boat or the RV. There are not many storage-specific facilities that they will have parking, et cetera, but they won't have purpose-built, maybe boat and RV parking. Maybe it's open air. We have some of that. We have some covered as well, 3-sided covered that we lease out, but not a specific purpose-built facility. Usually when you call around to try and find a parking space, they're full for the most part. So it's pretty difficult to find parking for those vehicles. So in other words, the demand was very high during the pandemic. They sold a bunch. The supply of parking is not very high. There's not that many purpose-built facilities out there, and the spaces that are available, they go for a premium. So you have a dislocation in a sense between supply and demand of space for those vehicles. The customer base, it's still storing a vehicle. It's not like it's rocket science, right? It's not a completely new thing. It's storing a vehicle, just not boxes. But they tend to be a different customer in the sense that they have to be of somewhat higher net worth because they are purchasing this, $1,000 vehicle. And so
You can get me an RV for $1,000?
Yes. It won't look very good.
We need to talk after this.
It may not work. But, yes, many thousands of dollars of the vehicle. And they tend to not pay late. They pay on time because they don't want that vehicle towed for whatever reason, or sold to Andrew for whatever reason. And they take care of their stuff. They pay on time. They're not late. They take care of their stuff. They're the type of customer that you want. So, and they will come from a further distance than the typical storage customer. Storage is kind of like a grocery store. That's kind of how I think of it. So your local 3 to 5 mile radius is your typical customer.
Sure.
In boat and RV, they can come to be out to 5 to 20 miles that's the trade area. That's where you're looking. And some come from 50 miles away to store their vehicle. It's kind of hard at first to wrap your head around that. Why do I drive 50 miles? Well, it's because good parking, it's safe, it's secure, it's indoors, it's whatever the case may be. I bought this vehicle, I want to park it in a good spot where I feel like it's going to be taken care of while I'm not using it. So that was a long-winded answer, but we love it.
That's what I wanted to know.
Yeah, we love boat and RV. So
yeah, especially if you're looking at the right type of boat and RV storage. And what I mean by that is, you can go out and buy, a massive, parcel of land or multiple parcels of land to do open parking. So not covered, not enclosed.
Gravel or whatever. Yeah.
Right. So, and those do not get the rent premium that a covered lot would, or an enclosed also is another big premium that you get. And they're also, lenders don't like them as much. Because they're not as pretty, they're not going to get that premium.
And there's not really there's no buildings.
I was going to say,
exactly.
They're lending on gravel.
Exactly. It's not something that they can, touch or anything.
Yeah.
So those are the ones that we are going after, is the higher class. We're going to get a better tenant, like you said.
Yeah.
So it's important to go after the right kind of boat and RV.
Can we nerd out about that for a little bit? What's the...
Andrew, you can always nerd out.
I know that about you.
I might go snooze alert on you.
Chris,
Not with Chris.
We'll wake you up in about 10 minutes.
Yeah.
So what is, if you've got just, and obviously it's going to depend on the market, location and all that, but you've got a baseline boat and RV that's just gravel, just pull it in down there and we'll, pay us $50 a month or whatever it is. What kind of premium is commanded for covered? What kind of premium is commanded for built? And again, just a range. And then what's the cost on that? And just to get an idea of like what the ROI is on a CapEx project if we were to buy a place and move it from, uncovered to covered or covered to, what did you say, completely enclosed? What is, ballpark kind of, what does it look like, the CapEx side of it, and then what does the premium look like on it?
Right. So as far as building so we'll talk about just a covered, facility. That can be between, depending on the materials you use, it could be between $25 and $35 a square foot. Okay. 35 would be on the high side. Mm-hmm. And to speak to the premium that you get, though, if you're just going to buy a parcel of land and have a bunch of open parking, you might get $50 rent for a space. If you have, a large space, you can park a large vehicle, and there's low supply in the area, you might get $75. We have a facility that has covered parking as a component to it. It's a storage facility, but it's got some covered parking, and we're getting close to $200 a space right now for that. And that's
so like a 300% premium.
That's right, and that is that's just covered. It's enclosed on three sides. Okay. If you go up to then sort of the cream of the crop, where you've got not just enclosed but climatized. Mm-hmm. So if you think about that from the tenant's perspective, it's more comfortable in there for their vehicle, and they don't have to winterize it. Mm-hmm. During the off season. Those are several hundred. We've seen some that are close to $1,000 per spot. So it's a month. Yeah. Okay. So it's very, now that's market specific again, sure. But you can easily get, over $500 a month for an enclosed climatized parking spot. So it is a significant premium when you're going after the right stuff.
Yeah. And for people that have that disposable income, that have paid, maybe a little over $1,000 for an RV or a nice boat or whatever, to them that's just the cost of recreation, of doing business. Okay. Yeah. Well, that's great to know. I didn't even realize that the premium was that high. So that's fantastic. Yeah. So we've hit that. I'm just going through the questions here, and if you're submitting questions, they're not, for some reason, they're not showing up on my screen here. And so if you submitted a question live and we don't hit it, we'll make sure to go back through. I'll get a list of the questions and we'll address those. So I think that we've hit most of the questions that came in ahead of time. What do you see as we talked a little bit about boat and RV storage. What do you see our biggest opportunities, right? So anytime there's a crisis, that always creates opportunity. And we talked about how we're positioned well as a group in our current assets and as a company, and because we have the amazing investor partners we do. So where do you see the opportunities in the space over the next, again, 12 to 18 months?
I think it's not obviously in change anything. It's kind of we're going to continue moving forward. Some groups, so we're going to continue moving forward with the strategy that we have, buying good deals in good markets with a good exit plan. So that doesn't change. The opportunity is going to be where we have seen the number of offers on deals drop off. So instead of 20 offers, or sometimes in some cases 30 offers on one deal, you might get 10 to 15 offers on a deal. And of those 10 to 15, we're always in the top 2, 3, or 4 offers on deals like that. Mm-hmm. So in other words, it's grabbing market share. Whether that be in brokers' minds or sellers' minds, of saying, we're still at the table. We haven't stopped looking at deals. We're still at the table. We're still going to be at the table next year when things maybe aren't so good, and we'll be at the table when things are good. And so we're going to grab that mind share in brokers' minds and sellers' minds that, hey, we're a reputable group. We can close on deals and assets. If we make an offer on your property, look at our offer because it's a legitimate offer. We've been around for a while. We know what we're doing. We can get this deal closed. So I think that's where the opportunity lies right now, is in grabbing market share, whether that be actual assets or grabbing market share in in the industry folks in their minds, that we're a reputable group and we're growing exponentially. So,
yes. Yeah, I think also in specific markets, I think there's opportunity with development still. You know, we talked about overbuilding before, and we talked about how there's kind of two sides to that equation. But if you are acquiring land in the right markets, you know, growing, you know, new population, and that lower supply, I think there's still a lot of runway left in development.
Okay.
You know, we'll continue to be obviously conservative in underwriting and very selective in which markets that we're pursuing that strategy.
Yeah.
But I do think that in the right markets, there's still opportunity for that.
Yeah, and I was gonna say too, in going along with markets, the markets we're in right now, of course, we're looking at other places too. We're not just focused on the Carolinas and like Denver, Colorado. We're looking in places in Texas. We're looking in Florida. We're looking in other states to make sure that we're not missing certain opportunities. There are other good growing cities out there that I can think of outside of, you know, some of the states in the Southeast, et cetera. So there's opportunities to expand the footprint beyond where we've traditionally looked at deals and saying, hey, is there a good deal to be had, you know, elsewhere in Virginia Beach, Virginia, you know, other places. So those are opportunities as well beyond that.
Makes sense.
Yeah.
Yeah. Real quick, development. What does a ground up storage development project look like from shovel in the ground to ready to lease up in terms of a timeline?
Okay, timeline.
Yeah.
Yeah, so it would depend on what type of facility you're building. So if you were going to do a single story, you know, versus a, you know, 3 or 4 story building, it would be different. On the smaller side, I would say from shovel in the ground, you're probably looking at a 6 to 9 month construction period to where you get your CO. If you're building more of a multi-story building, there's more involved in that, then it could be 12 months or longer, depending on just weather condition. I mean, you know, all the things that impact construction.
Yeah. Okay. Very good. Well, I want to thank you guys both for your time today and showing up to meet with me in person. I know this is really valuable, and we get a lot of questions about this asset class. And so, any final parting words for our investors, or anything you'd like to say? And it's okay if you don't, but I just wanted to open up if you had any final thoughts.
Yeah, I think it's important to remember right now. So we've talked a lot about some uncertainty and you know, the potential recession that we may be in now. I think it's important to remember that if you are using the right strategy and you're being conservative in your analysis and your underwriting, you know, there is profit to be made in any real estate market.
Yeah.
As long as you're looking in the right markets, you're being conservative, and you're not being, you know, aggressive and reckless. There's profit to be made in any real estate market, just like we're in right now.
Yeah, and real quick, you said conservative, and I know that you have a famous reputation within the group for being very, very conservative, which we love about you. So. Tell me in terms of debt terms right now, because one of the things that makes a deal conservative, right, is how leveraged you are on that deal. So what are we looking at in terms of kind of our loan to value, right, or our loan? What's that ratio looking like on kind of as we're underwriting deals currently? Where do you like to see us?
I like to see us in the 55 to 60 range. For example, the last storage fund that we did, which is still an open investment, that one is 50% leveraged. It's at about a 5% rate, a little north of 5, and so that's a very conservative, you know, underwriting. And there's a flip side to that, of course, when you have a lower leverage deal. But that is an asset that's very well positioned to weather any kind of storm that may or may not come up.
Yeah,
So.
Yeah, that's a very strong position. Yeah.
Yeah, 100%. I think anything to say to the investors, I would say thank you. Obviously, thank you for trusting us with your capital and going out and finding deals and placing that capital. So it gives us a tremendous opportunity, I think, to partner together and you know, put capital in these assets that we know are going to perform well into the future. I would say look beyond just what's happening in the next 12 months or 24 months. If we're all investors, and I believe that anybody watching this is an investor, you want to have the long-term view of things like the Warren Buffett talks about. You know, place your money. Generally speaking, the retail investor, put your money in the S&P 500.
Yep.
Never check it again until, you know, 30 years down the road.
Yeah.
Whatever, that's what you should do. So try and think long term in that regard. We're buying these good assets in good locations, like John was just talking about for our self-storage fund 2 and beyond, the ones that we're looking at. So we take a long-term view of things. The capital markets are strong as far as storage is concerned. And we believe it'll weather any storm that comes up in the next 12, 24 months or so. So
Perfect.
absolutely.
Excellent. Well, thank you guys. Wanted to thank all of you who are either attending live or are watching us. We will put that link back up. So if you'd like to schedule a call with myself or my team to talk about anything we've discussed today, hear about opportunities, whatever it may be, we'd love to connect with you. And again, feedback. And so this is now the second kind of town hall we've done like this. As I mentioned, we did one with the 3 managing partners of passiveinvesting.com back at the end of October. And would definitely encourage you, if you didn't get a chance to watch that, to go back through. We spend a lot of time talking just about our overall strategy, experience, really kind of our forward-looking outlook as a group. And then I always really value your feedback. And so as director of investor relations for our group, it's really, really important to me and my team that we know what kind of communication is meaningful and valuable to you, especially in a more volatile economic time, right? And sometimes we just need those touch points of, okay, we're still, my dollars are still invested well, we're still in a conservative spot. And so please let me know. You can just send me an email, andrew@passiveinvesting.com, and let me know what you'd like to see from us in terms of future content, what was informative to you, what you didn't care about, whatever it may be. You can't hurt my feelings, or you'd have to really try hard. And really, again, just want to thank you. Chris, thank you earlier. These guys we're all so appreciative of your partnership. You're truly partners to us, and our business doesn't exist, and these opportunities don't exist without each and every one of you that's invested with us or in the future will be invested with us. So thank you for your time. Thank you for your ongoing trust, and we'll look forward to connecting with you soon.